Hey guys and girls, welcome to this week's episode of the B.Invested Birchy podcast. I'm your host, Nathan Birch, and this is the show unraveling the truth to the facade of the 21st century when they exit the matrix and waking up to motherfucking reality. Today, we're going to be talking about investors losing out when buying property and what to look out for and how to protect yourself along the way. Some interesting stats now, just on my numbers of what I buy for my investors and for myself. I'd say probably 70% of the properties that I personally own and my investors own have been purchased at a cheaper price than what the poor bastard previously paid for it. Most people, I call myself a contrarian investor, this is what I do, right? So when I think about it, a lot of investors will see something, and I'll just use for an example, this example of a location, right? Let's just say I don't know, Gold Coast or Townsville or Perth, right? They'll look at the Gold Coast and they'll be like, Gold Coast, it was 200 grand in 2018 and now it's 400 grand in 2022 and now it's 700 grand in 2025. Must be a good deal because it keeps going up in value. They'll look at Townsville and say, well, it was 100 grand back in 2020. It was $200,000 in 2022, and now it's worth $400,000. It's a fantastic investment because it always goes up. Same could be said for Perth or said for other areas. But what a lot of people don't look at is that they don't look at the fact that, between 2009 and 2019, the property in the Gold Coast that was 200 grand in 2019 might have been 350,000 in 2009. And if you picked up that snapshot of the market where it went backwards over a decade and you bought it in 2019, a lot of people would think, I reckon 95% of the herd mentality would be thinking that's not a good investment because the thing's gone backwards for 10 years. The same thing has occurred in Sydney. There's still properties in Sydney that I buy today in 2025, which sold in 2016 for 400 grand. I'm picking up, for 350,000 in 2025. So a decade that's been lost. And a lot of people would find that hard to fathom, that a property could be in a capital city cheaper. A lot of people would find it, hard to understand or get their head around the fact that, hey, that's a good investment, right? Because, they'd think that it hasn't gone up for a long while. But it goes to show no matter which capital city, which market you're in around the country, there's times where the markets go up and there's times where the markets go down. We've all seen Bitcoin go up from 20 grand to 100 grand to come all the way back down to 30 grand again. Most people get hyped up when Bitcoin's at 100 grand or 200 grand, but they're not excited when it's 60 grand or 50 grand or 30 grand again. So you need to look at the psychology of the market. You need to look at, lots of factors when buying assets. Don't get caught up in the hype. Don't get caught up in the illusion. Don't get caught up into bubbles. And, it makes me think my topic of today, and to getting back on track of the topic of today, is why a lot of people lose out on buying properties or investing in anything. So firstly, I love, right, as I said, 70% of the time, I believe, I've bought a property cheaper for myself and for my investors. Tens of thousands of properties I've bought over the last couple of decades. That those properties, for me, that's exciting when I'm buying it cheaper. But when you look at the flip side, who's the poor bastard that bought the property for 400 and sold it to us for 250 or whatnot? What were they thinking when they made that decision? What information were they provided with? And the ultimate question is, why did they sell and why didn't they, just keep it now and watch it go from 200 grand to 600 grand and stick to the original course? And I guess there's lots of factors that come into the reason of that. I think the first one is buying on emotion, not having a plan, um, and probably dodgy advisors that are out there. Dodgy advisors are a big one. And those dodgy advisors could come in the way of a financial advisor, could come in the way of some real estate spruiker, could be in the way of someone telling you to buy some hyped up thing in a hyped up location, which is the biggest fear I see out there for investors in 2025, 2026, is the amount of, you know, gurus out there selling stuff, right? Buy the house land, buy the thing with the granny flat, buy the off the plan property. It wasn't. I've seen these things over the years evolve, right? In the 1990s, um, I always used to say you'd fly. What would happen, right? So in 1990s, there was a lot of people that there was no internet. Right? Let's just go back. There was no internet, there was no research, there was no data out there. There was, oblivious investors, right? And you'd see them, someone from Sydney, for example, let's say the house was 400 grand in Sydney, they'd fly you to the Gold Coast and sell you an off-the-plan property and say, this is a very good house and land package or whatever. It's 200,000. And now, look, in retrospect, 30 years has passed, everything was good, right? But at the time, these people would hop on a plane, get off at the other side. You'd have a guy in a suit walk you to his BMW 3 Series or whatever, take you for a drive. Don't worry about it. Oh, it's all on us. We'll pay for accommodation for you the weekend. Think of it as like a little holiday, guys. Think of it as a holiday for you to come up and spend time on the Gold Coast. So people would go on these holidays. They'd come back with buying 2 or 3 properties in their portfolio, and they'd be off the plan. The problem is that the valuations never stacked up. The problem is that they were paying 300 grand for a property that was worth $200,000 at the time. And they would have to sit in these assets. They'd generally have to sell those assets, right? So the people that back in the 90s, the scammers, were the suit and tie, fly you interstate, sell you with the beamer, take you around, give you a weekend holiday for free, whatever. And I always said, I remember I was like 13, 14. I had this girlfriend at the time, and I remember her parents were buying some off the plane things. And I said at the time, like, that sounds weird, right? Like, who wants to listen to a 13, 14-year-old kid, right? But yeah, I just looked at it and I was like, I observed that at the time. I was like, that doesn't feel right. Yeah. And then years went by, there was like these property expos, right? And you'd have either expos where everyone would get into a room, see what hot deals or hot things with properties, or you'd have like an article where you'd have a get together where people would meet up at like a Ridges and stuff like that, and they'd do an event or a seminar. So those events, there was a few things that happened at that point. You'd have off the plan salespeople selling house and land packages, selling units off the plan, and they were selling. There was a lot of jewel key and holiday rooms that were being sold, like motel rooms and holidays at the time. And there was another thing which isn't really related to property, but it is. It's called timeshare, right? And I haven't really heard of timeshare. I think there's a company called Group that bought a lot of them up and amalgamated. But timeshare companies, where you buy a share in a holiday letting pool, is the biggest Ponzi scheme sort of out there. And people just go along as the information day, and the next minute look at these hard pressure salespeople at the back of the room selling you off the back of the calls. Then it evolved to little groups of people which get together and they'd sell granny flats. So they'd sell renovation packages to houses and then granny flat building out there. A lot of those companies got into trouble in the probably around 2010s. Was from the first round of buyers agents that were in the market and are selling these things. And then Jewel Keys, NRAS, NBIS. So NRAS was the National Rental Affordability Scheme around the Kevin 07 era. Then there was NBIS now is out there. The Jewel Key house and land packages. There's lots of different eras. A lot of them as well are these big developers who fly the Chinese out to Australia in the maybe 2010 to the 2015 era. Was a lot of Chinese that were investing in brand new properties that were off the plan. And they didn't know there was parking cash in Australia. Information very crucial. So dodgy actors out there is why people lose money, but without having a plan. If you have a plan, you can see, hey, this doesn't add up, doesn't stack up, that don't work for me, it's not a viable model. I don't look at it. For me personally, I've never been lured or baited by those sorts of things. As I think about it, I'm in my 3rd decade as an investor. Wow. Right, just running through that timeline. People lose money from, not having the knowledge, but having the resources, not being educated, and getting emotional, because I think a lot of those people get caught up in emotion. So it's the first and foremost, you got one of those actors in one of those times, in one of those periods, in one of those places. Ultimately, you look back and everything looks good today. And there's some markets that you can still buy, in the middle of that cycle. It could be Melbourne. Right? I buy stuff in Melbourne today for 350 grand, which used to sell for 450, 500 10 years ago, brand new. In 2015, people asked me, what do you think about buying in Melbourne? It's a great hot market. I was like, rubbish. Don't buy that. I don't like it. I wouldn't invest. I found a bit of value in the Gold Coast. People asked me about the Gold Coast when it went off. So I was like, no, I'm finding a bit of value in Council, Gladstone, Perth. Those areas are going off now. It's like, should I be buying in Perth? No, right? I used to buy 50 properties a month in Perth. I don't buy that anymore. But just because I don't see the value, I see people getting set up to be slaughtered. So looking for that value, having a sound strategy. If you have a sound strategy, you won't be lured by your emotion. The logic talks when your emotion tries to overspeak. So any of those people would have been sold on the premise that, hey, you can get some tax benefits, or would have had some, you know, rah-rah of gentle of some sort. And they'll talk about a tax, how you can save on tax, and some flip charts, right? Flip charts like an airplane presentation. Oh, this is what it could look like. This is what growth could potentially. And all those things are potentially, hopefully, maybes on Monday. They're not real figures. So yeah, if you know your numbers, you know you need the stock to fit into your business. You're investing as a business. Your stock is your stock like you would have in a shop. So you need to make logical decisions on your numbers. And ultimately, your emotion that goes, oh, it's brand new, it's got depreciation, I don't have to do the renovations. Oh, imagine having a party here, imagine living here, imagine, retiring at these places. They're the illusions that get people killed because they're behind off their emotions. So I guess there's all that element as to why people lose money in investing. But I think the other aspect, and it goes back to the foundations of why you're investing, not having the right roadmap, not having the right plan, but just going along with the flow, right? I see people that have become very successful, right? I've been doing this for too long now as an advisor, as a buyer's agent, as a educator, and I've seen people come and go. I've seen people come and go in the format of they've come to the table with 0 properties, they've gone and bought 10, 20, 30 properties, and then they come back with 0 properties or 1 or 2. And another era that I forgot to talk about there was the mining boom era. And the mining boom era is where people got screwed from buying mining properties because they didn't realize how commodity cycles work, how super cycles work, what how mining companies work in general. And they've been caught up in hypey boom times and alluded to, I bought a property for $1 million, rents for $2 million a week, but there's no one to rent it. The property's only renting for $200 a week. Property value goes to $100,000. Everyone does their ass, holding a negative, highly negative cash flow property, etc. So, understanding, having great level of knowledge on that stuff will help you, minimize that risk. Maybe the next one, did a podcast recently talking about the AI data. There's all these experts talking about AI data. That could possibly be one of these that could be the next button that comes. But whatever it is, you need to have a plan, you need to have strategy. But I see these people which could get 10, 20, 30 properties in their portfolio, and for some reason, they started out with a solid plan. They started out with a solid strategy. But when they got to a certain level, they stopped doing what they did to get to that level. They became from a creator to from a producer to a consumer. Successful people keep doing their right habits to be successful. Unsuccessful people get to a level, and that's where they start changing their habits, right? They might start doing bottle service. They might start buying cool cars. They might start, at that point you are going against, right? Yeah, you've got the ability to do something, but whether you keep doing what you were good at or whether you go and become a consumer of things and you start depleting your position. I've seen people that have had very good portfolios that have built. They've got to a course, they've had the harebrained idea, they've had something that occurred. They go, I'm going to become a developer. I'm going to sell off all these things. We go over here and do this. And they start making decisions which are anti what their original plan was. And it's okay to change plans. It's okay to go off strategy, right? But you want a strategy that works. You don't see a successful business going, let's start doing car washes in the back of the McDonald's, right? Their bottles McDonald's, right? They don't go, well, McDonald's, we've got pizza now. We've got all the people that are hungry. Let's just start serving out pizza. That's not their business model. So as an investor, you need to work out, where your value is and what is your strategy, and sticking to that for the long term. Um, for seeing people, and the way I could put it down is that they've had a run on something, and it might have been a bit of luck, it might have been a cool strategy, but when they changed it, you can literally see that their position took them this path in life instead of going along that journey they were on. So you might be on the journey of developing. That's cool. You might be on the journey of renovating. That's cool. You might be a flipper. You might be subdividing blocks. You might be in the commercial property. If you have a strategy, just do it with make money in all areas of real estate. There's so many areas to make money in. But if that's your model and you've got a model that works, stick to your model that works and just multiply it as many times as you can to get the result that you need. But yeah, I've seen so many different. When you don't have clarity on the goal, once you don't have the clear vision, that's where the risk comes into the portfolio. I think in a world today, it's very different as well, right? As I said, 1990s, 2000s, it was different eras of people getting fucked over. Here we are in 2025. You're listening to this from your device, whatever device it is, a laptop, your phone, your iPod, whatever, right? From who uses the iPod today? The thing is that you have access to Facebook, Instagram, TikTok, all that. And as you flick through this media today, there's different algorithms that you fall yourself into, right? You could fall yourself into a lifestyle thing, right? It's easy to go, oh, this guy is cool, he's got a Lambo, he's got this, he's got that, and be sucked into different ideas or different strategies, which is cool. But yeah, I look at it with very caution because you want to see that you know there's substance behind it. I see these things in my Instagram reel now, and I see a 20-year-old kid in Bali saying buy Bali houses, right? And it's like, cool. What's your experience on Bali, right? Is it going to be the Bali bubble? Right? Is it going to be the Philippine bubble? Is it going to be what's the next hotspot, right? I saw some dude the other day in news.com that said it's buying properties in Japan, right? Is that cool? I'm sure there's ways to make money in everywhere, right? You can be an influencer, you can look successful straight away with all you need is a mobile phone, right? A mobile phone, um, it doesn't cost you anything to appear as successful today. So just be very cautious. I see a lot of people talking about these Bali properties and buying them overseas, cash and all that. And I'm like, I remember these people that aren't allowed to do business in Australia, right? And I'm not calling out people here. I'm not bad mouthing certain people, but it's people that have been kicked out of the country from doing business or operating for 10-year bans, right? For unscrupulous alleged things that they may or may not have done. I'm not alleging anyone did anything, but suddenly they're selling these new whiz-bang things which fall out of, um, you know, ability to be controlled within the country. So just be really cautious, right? The other one I forgot about was people buying in America. I never did that, right? A lot of people made money out of that, which was cool, right? So it's not that everything's bad. It's just being cautious and knowing the risks and having a strategy around it, and not getting caught up in a bubble. The bubble is where all the hype gets around something, and that's where euphoria comes in, and stupidity and emotions and all that kicks in. So, yeah, looking at other areas of people losing money. Why does someone sell the property cheaper, right? Why don't they just keep it? I don't know, right? I don't have all the answers for it. But if I was to go and look at all the numbers of these people don't even need to sell a property. I'd say 70% of the stuff that I buy, as I said beforehand, is below what someone paid beforehand. But even if they've sold it for 100 grand more, if that property was a negative cash flow for the last 10 years by 200 bucks, 300 bucks, 400 bucks a week, person could lose money very easily. Over a decade, and they're selling it, making a technical loss on the property. It might appear that they're making 100 grand, but they might have lost 200 grand by owning it for that period of 10 years. So you need to make sure that your numbers stack up, your plan is right. And the reason why I think people, like someone bought a property for 200 grand or for 300 grand, it went down, they sell it for 200 grand. They're just drained. They've had an asset that's been dragging them down for a decade, right? It's had negative growth, negative cash flow, whatever. And it's at that point where the rent starts going up, where it could have been 300 bucks a week on a 300 grand purchase. It was negative for a decade. but the rent goes from $300 to $400. The person's just drained. They don't know that the rent's gone up $100 or it's going up $100. You buy it for 200 grand and it rents for $400 a week, and suddenly $400 on a 200 grand purchase is tremendous. But then the market goes from 200 to 400, which is what the previous owner was hoping for, and then it goes from 400 to 600. Suddenly you've just tripled your money, but the poor bastard before you didn't realize that. So why would they sell? They could be drained, they could be tired. Um, but most importantly, they're not, that they could have been holding this asset that could have been bleeding them for a decade. And it's at that point where it's like they can't economically or financially, hold on to that deal anymore, which is why they'd sell it. So I guess, how can you avoid that from happening? Educate yourself, be cautious. Don't just look at data from a year or 2 years or what could potentially be. Never look at what a deal could potentially be, right? It's good, it's fantasy, that's cool, but look at what it is. Look at where it's come from. You don't wanna be looking at potentially 10 years in the future. You wanna look at the potential of where the 10 years that it came from. Just because the property's gone up and performed well for the last 5 years or 10 years does not mean that it's gonna be able to continue that. Quite often, and quite contrary to this, I found the properties that have gone backwards for the last 10 years have the lowest point to take off from and have the biggest bounce from, and that's where the best results have been. I was filming some Birchy vault videos recently, and without jumping into it, when I was filming the Birchy vault videos, I was looking at deals from 10 years ago and 20 years ago and talking about what we paid for them, what they're worth and all that. And I noticed trends within those markets of my own data, and they've all done fantastic things. But when I look at an area, let's say Vaucluse in Sydney, right? People think Birchy just buys shit boxes in regional towns, right? I buy everywhere. Um, and I look at the value of that, and I look at what a little two-bedroom unit in the western suburbs of Brisbane, the rough areas, that's quadrupled, which would have been deemed as crap property before, where something else is only doubled, right? So it's, yeah, it doesn't necessarily mean that something's come from somewhere that it's going to perform well. The factors that are most crucial for people today, which I think are very important: migration. Where's migration going to? Because that's where your tenants or your demand's going to come from. Um, what does the income of the people look like versus what the mortgage could support? So if everyone's on 100 grand, let's say you've got a household that's on 150 grand income, but the average house price is $1.5 million or $1.2 million, the chance of that going to $3 million, the incomes of the people that are around that location can't afford for it to go to $3 million. So what's going to be driving that price to really get it to $3 million? Either interest rates have to drop all the way down to nothing, the wages have to get really heavily inflated away, which, they're two risk factors that are there. But somewhere 20 minutes away might have an average income of 130 grand, but might have a house price of 300 grand. And it's at that point where it's like, okay, the income of 130 grand could support a house price of $1 million quite comfortably. That has a possibility of doubling, quadrupling, tripling over a period of X, Y, Z. So understand the numbers, understand the markets, understand the research from behind. Look at not just out the front window of, oh, happy days. What happens if it doubles? What happens if it triples? Because it's all good to, you know, fantasize about what something could be in the future, but you want to know where it came through and why did it get damaged beforehand, and what does the upside look like in the future with the recovering of what caused that damage. And I can go very clearly into any of these markets, whether it be a mining town, whether it be any of those markets I said beforehand: Sydney, Brisbane, Gold Coast, Cairns, Townsville, Perth, Northern Territory, Adelaide, Melbourne. I can tell you what happened at those points when those markets crashed, and I can tell you what happened looking back of what caused those markets to take off. And then when you look at areas that have doubled, tripled, or quadrupled, there becomes a scary part where it's like, hang on a second, that looks too cooked. That could look like one of those charts in one of those bad areas at the moment, and it's formed. And in 10 years' time, you'd be sitting there going, wow, remember when that market peaked? So research is very important, but most importantly, the strategy and having the right game plan, the right actions to be able to take, along the way, because it isn't a get rich quick. It's not a, it's easy, as I was saying, with, your Instagram, your TikTok, LinkedIn, whatever. Not LinkedIn, I don't use any of these things, but it's easy to go, hey, this looks cool, and buy into a quick rich or a quick win, but you want a sustainable portfolio. You want a sustainable asset base that's going to be lasting you for decades to come and to produce and provide for the rest of your life. So it's important to have that long-term view. And when I say the long-term view, a lot of people say, oh, it'll double in 10 years, or it's going to go up, whatever. It's cheap and easy for people to say things are going to go up. But yeah, the data and the information is what's crucial, and that's what I look at when taking bills and executing on bills. So on that note, guys, hopefully there's something there that can that I've shared with you today that's given you a bit of an insight or the penny drop. You know, I think of the year 2000 as 5 years ago, right? But the reality is the year 2000 was 25 years ago. That was 2/3 of my life ago, was, back when that occurred. So looking at it, that data and what's caused for any of these markets to move or adjust to get to where they are today, we'll be looking back in another 25 years. Hopefully, we'll all still be here. And looking back going, shit, remember when this happened, remember when that happened? And it will be on a chart and it'll be undeniable for all of us to look at. Just make sure you're on the right side of the chart and you're on the right side of the numbers and you have the right strategy there. If you need help on building out a strategy or getting some advice or getting some feedback, feel free to reach out. Give us a buzz, 1300 367 925. Email us, admin@binvested.com.au. And if you have any questions, drop them below. My team will pick them up and we'll make some more podcasts around what you guys need and are after from the data. So we'll speak soon. Thanks a lot for watching. Every Thursday, Google Play, Apple Play, Spotify, and YouTube. Thanks, guys. Bye for now.
Like Bilal said, man, we stuck in the matrix. This my advice, don't care if you take it. The dollar back to die, soon to be hyperinflated.